Well, hello everybody and welcome back to the Neoclassical Principles Technical Analysis Neoclassically. This is going to be the nuts and bolts of the system. It's not going to be so in-depth that you're going to be an expert by any means. It takes a long time to learn anything, inside and out. Neoclassical TA, the model is no different. But what you will learn here is you'll learn a lot about what neoclassical is and why it's important, and why, if you really want to stand out above the crowd, you might want to take a hard look at how it works and why it gives you as good of indications as it does. Now, I want to jump straight into the charts. I want to use the charts interactively here with the ideas and show you what the difference is here to start with between classical and neoclassical. And I'm going to start with a very simple, unaltered chart that just shows you price, volume, and time. And this is on a common stock DuPont 6-month time frame daily chart. That's nothing but time, price, and volume using candlesticks. Now, I'm going to flip real quick and show you what it looks like on one of the classical TA sites. This happens to be stock charts. People use this quite freely, and they use it a lot. And it has some of the common technical analysis things that everybody uses today. And everything is based on trend. And everything's based, classically, everything's based on moving averages for the most part. This actually is MACD, which is moving average convergence divergence. It's an indication of momentum. Same thing here. This is RSI, a different indication of momentum. It also has overbought, oversold lines. And being able to use these really depends on the tone of the market. Sometimes these will give you good signals, sometimes they won't. What you really want is something that gives you good signals all the time. And what that is, in my mind, is something that's really based on what's significant on the chart. When I look at a chart like this, I can see that somehow that bar is significant. It just stands out, right? And I can see that this one's significant somehow. But how, right? That's the question. Neoclassical is always interested in supply and demand on the chart. We're trying to determine where the supply and demand is, because supply and demand drives everything. And if we can view that supply and demand on the various time frames, and what I mean by time frames is here's a weekly chart, exactly the same thing. Here's a monthly chart, exactly the same thing, right? If we can view that across all those time frames, and we can figure out where supply and demand is, right? We're going to have a much better chance of understanding whether people are really buying this thing or not, or selling it, right? Is the supply greater than the demand, or the demand greater than the supply? That's what creates trend, right? And so what we want to do is understand what is the trend, what are the significant parts of the chart. And once we understand those, we can actually wrap our heads around that and use it to make money. Now, unlike classical TA, where you can get an overload of information, because there's some 200-300 indicators nowadays, right? Now that we have computers, we've gone crazy on information overload. And a lot of times that information analysis leads to paralysis and you can't do anything. Unlike that, with neoclassical TA, you're only going to see 4 or 5 different types of things on your chart. And what it's going to be focused on is trying to identify exactly what is and isn't important. And the first thing that's important is trend, right? The old classical TA was about trend is your friend, and that's true. And it was about a series of higher highs, right, and higher lows, telling you what trend is. But then what do you do with something like this? Right? All of a sudden you get a lower low. Does that change the trend? You know what I mean? I mean, all these things matter, right? If you're going to use this general definition. Unfortunately, classical TA never really identified in a methodical way what trend is. There is no definition. Go through all the literature. There is none. In my 2009 book, or actually it was 2011, Trend Qualification in Trading, which introduced the neoclassical model, we specifically and methodologically identified what trend is, and it has to do with swing points. So let's look at those. On this screen, now we have swing point highs and lows identified. You can see them designated by the H's and the L's, and you see it all across this as the trend continues to develop. What are swing point highs and lows? A swing point high is any bar where you have a high, and the next 6 bars, 1, 2, 3, 4, 5, 6 bars, the next 6 bars do not have a higher high. So essentially what happens is this is a potential swing point high because it's higher than the prior and has been contained as the highest bar now, 6 bars. Once you reach the 6th bar, the potential bar becomes a swing point high. It gets an H designation, and you start counting again. Is this high higher than that high? Well, it is, so that one is the potential swing point high. Is this high higher than that one? Yes, it is. So this one now is the potential swing point high. Is this bar higher? No, it's not. Okay, so that's 1 bar. Is this one? No, it's not. It's 2 bars. Is this? Oh, this one's over it, right? So this one now is the potential, and you forget about the rest of them, and you keep going. And you do that until you get 6 bars that are lower highs. Conversely, if you're doing swing point lows, it's the exact opposite. In other words, if I look at this low here, and I say, is there 6 bars from that low? Afterwards, 1, 2, 3, 4, 5, 6, where I don't get a lower low, none of these are lower, that becomes an actualized swing point low, and it gets an L designator, and you do that. Now you have swing point highs and swing point lows, and now you can start thinking about trend and trend changes. How does trend change? Well, you have to break a swing point high. You have to get over it. So in other words, if I take this high, which is 68.54, and I look at this high, 68.68, I could say, oh, that broke it. Well, no, there's another rule, and that is that it actually has to close over it. So we really don't get the break until we get this bar here. That's the bar where the break takes place. That gives us a trend transition. And in neoclassical TA, we show those trend transitions with the use of arrows, as you see now. Where is that break? Well, as we just said, that break takes place right here on this bar. And there's the arrow showing you that a trend transitioned. Previously, that trend in this particular case was down. It was negative. Not negative, but it was bearish. Now you get a sideways trend. Sideways trend means that we broke over. We were bearish. Now we've broken over a swing point high that transitions the trend from what was down, right? The trend was this way. Now it's sideways. Sideways is always the in-between between bearish and bullish. You don't have to go bullish if you go sideways, but a lot of times you do, and actually in this case we did. But you could go back, right, to a negative case. But that's how trend transitions. Swing points are broken. That allows transitions to take place. And a lot of times what you'll see, if you could pull this back, right, you would be able to see that in this particular case, there was a swing point low over here somewhere that was broken to the downside, which is what transition trend lower. We keep a running tab historically, even though the bars fall off the chart, so to speak, to the left-hand side. we always keep track of where it is. So here we can see a break. This one's on the screen. You can see this trend transition here. There was a swing point high over here to the left off the chart that was broken, and that's what you're seeing all the way up here. Now the other piece of this is the color designation. You can see a red, this one here is a red one, and then you see green ones. What's the difference there? Well, that gets into trend qualification, which was the title of the second book, and that is that we can look at flavors of trend. We can have very strong ones, and we can have ones that are not as strong. We call the ones that are not as strong suspect. That's the red here, suspect trend. The ones that are green are called confirmed, just designators that we put on them in order to tell what they are. What's the difference? Well, if I have volume on a break when a trend transitions, if I have volume that is higher, in other words, it's greater, and in this case it isn't, you can see the volume over here is a lot larger than the volume here on this break. So in other words, when we transition the trend, the volume on that bar compared to the volume on the bar that we broke. If it's suspect, in other words, it's lighter, you'll get a red arrow. If it's heavier, in this case we can't see it over here, but this one was heavier evidently, that is confirmed. What's the difference? Well, confirmed trends have a higher probability of continuing versus suspect trends. It doesn't mean suspect trends can't continue. It simply means they have a little bit lower of a probability of continuing. That's trend. That's how trend is designated, and trend is your friend. And once you see that you have transitioned from down to sideways, now to up, right? As long as that trend up continues to reassert itself, you want to be in the direction of the trend. That's trend qualification in a nutshell. That's neoclassical trend on the charts. Now, trend is one piece of it. The other piece of it is timing. And if we look at timing, timing is all about what's important. And so you have to be able to tell what's important on a chart. Well, given that we have price, we have time, and we have volume, certainly we can consider things that are important which make sense. In other words, we don't have to take and guess at it. One thing that's clearly important is our swing points, which we've already talked about, right? These swing points are important pieces of this chart. So any bar that ends up being a swing point is an important bar. It's a bar that we should be focused on, and that we should use information about tests that occur on that bar as something that's valuable that we can learn from. But it's not the only thing. There's other things. And one of those is volume. When we look at this chart, we can see that volume is higher on some bars than it is on others. And in fact, we can take the highest volume bars and we can identify those as high volume bars. They become significant. And so on this chart, and on all TA Today charts, there's 60 bars. Of those 60 bars, we don't want more than 6 high volume bars. So we take the highest 6 volume bars as long as they're higher than the average high volume bar by about 1.5% greater than the average. So if we take the average of all the bars and then we say, okay, is this that much plus 1.5%, right? Then it's a swing point, or it's an anchor bar, high volume anchor bar. And so on the charts, we've now identified 2 types of events that we can use as telling us a bar is significant. And why are we interested in that? Well, because we want to know what to pay attention to. You can't have every bar on the screen be valuable. Only some of them are valuable. This bar, valuable. Why? It has the highest volume of all the bars on the chart. Matter of fact, these three together all have significance, right? Because they're all high volume. We also know that swing points are valuable, so we can use those. What else is valuable? Well, there's one more thing that's valuable, and that's wide price spread. And we see wide price spread here on this bar that we were just outlining. This is the widest price spread bar, and just like high volume bars, if we take the average spread of all the bars, and then we say, is this one 1.5% as big as all the average? If it is, we take the top 6 of those. There's another one here, right? And we can pick them out. There's another one there. All of those become significant. So now we have 3 things that we can use as significant. We have swing points. We have high volume, right? All these high volume bars. We also have wide price spread bars. And we can have up to 6 wide price spread, 6 high volume, and we can have however many swing points there are. And there usually won't be more than 6 or 8 on a chart. And all of those, and we'll just take the 8 number, all of those together gives us things that are significant. And once we know that, now we know what to concentrate on in terms of our timing. And we can combine the intersection of those bars or the congruent area of those bars to create anchored zones. We have anchor bars creating anchor zones, and here those are. And now you can see what's most significant on this chart. This area here, and the fact that we have trend that's going in this direction, right? Once we know that, we have something valuable that we can work with. Trend is higher, it's higher, it's higher, right? All of these telling us trend is up. And matter of fact, the breakout of this bar was a key event, and it was something that we could have traded. We could have traded a number of things based on a timing perspective of this particular chart. But what we know now is that anything that retraces back into this area here is almost certainly going to be bought. And I suspect what will happen with this chart in a little bit longer period of time is that you're going to see something up here form in terms of a green support area, just as you're seeing down here. And we'll be surprised if it doesn't. We'll see something up here form similar to that up in this area, telling us that that also is support in an area that one can expect. What? Support means demand. You know, if you want to think about what these things mean, support, as shown on the chart, is that's where you expect demand to show up. If you see support on a chart, that's demand. Now, if you see the opposite, which would be resistance, that's going to show up, and we don't have any yet on this chart because this chart is nothing but bullish. But if you had resistance, it will always be above where price is, just as support is under it, and it will show up in the red. And so you'll see resistance up above. And in fact, you'll also see on any of these charts, you'll see a overlap whenever there's overlap, showing you this is strong support, right? It's a darker green. And so in this particular chart, you could see that anything that comes back just to the top of the support area is probably a buy point had it gotten there. And it didn't actually get there because this market has been extremely strong, as evidenced. Now there's other things that we can do. We'll talk about those. You can do ABCD structures. And some of these other things like ABCD structures, even though we have in Neoclassical a small twist to them, they are from classical standpoint, and that's a projection tool, just as we use the range tools. But we do not have that many things in this model. About 6 to 8 concepts that we apply over and over and over again, and they're all probability based. We know, for example, what the probability is for any kind of a breakout that takes place. For example, on this particular breakout, once it took place, we know what the probability is that any kind of a push back into this will or will not be bought based on, in this case, a retest regenerate. And we'll talk about that here shortly. We know what the probabilities of that are based on how soon that takes place with respect to time. But before we get too far ahead of ourselves, let's go back to the documentation here. Neoclassical principles allow you to view a chart, understand what's important, and understand how price is moving and testing. Markets don't know where they're going to go, just as the people that trade them do not know where they're going to go. Not with certainty. The way a market decides where it's going to go, and I'm sure you've heard this term, is through price discovery. In other words, if we pull that chart back up and look at it again, so I'll grab it up and throw it up here again. Price discovery is a testing process. That's how price discovers where it wants to go. For example, if we break over a swing point high and then we test back into it, as we're doing here, right? We're testing whether that demand is great enough to push prices up or not. That's what's being tested. And if that test resolves where demand is greater and we see price then break another swing point and head higher, the market has voted with its pocketbook that price should be higher, not lower. And if that's the case, you can expect that to continue. That's how the market decides what is, where price should go. And it's not just willy-nilly, it's based on tests. And those tests are underpinned by people buying and selling. In other words, supply and demand. What you always want to do when you're looking at time, price, and volume to get your best reads is you want to combine them all, and that's what we're doing in Neoclassical. And if possible, you want to look at multiple markets. In other words, you want to take and look at those markets where there's congruency taking place across them. So in other words, we're going to look at our domestic and international markets. We're going to look at the major sectors. We're going to look at the gold, the silver, the copper, the commodity markets, the bonds, the currencies. All of those are important. And the more of those that fit together, that support each other, the stronger the market is. Now, naturally, they're not all going to move together because some of them work opposite of each other. But if I'm looking at a strong market and I'm looking at, in the particular of this particular stock that we're looking at, DuPont, if I'm looking at the sector of DuPont and I'm looking at the general market and both of those are moving together, then DuPont, the stock, is probably not a bad stock as long as its chart looks good. Now, what we've done in Neoclassical is we've done two things, and we've boiled everything down to two types of trades. There's either breakouts or there's retraces. There's nothing else. Everything else is a derivative of those two. And so if we move back here, when I say a breakout, of course, is where you have a swing point high and you break over it when you get over it. A retrace is where you come back to test it. In other words, this bar. And where does that retest take place? Well, it takes place on a concept that we call retest regenerate. You take the high and the low of the swing point high that was broken, and then you look at the test of it. If that test comes within 6 bars, So in other words, once we break out, which we did on this bar, the green, if the test comes within 6 bars, which in this case it came on the very next bar, then you should expect that the lower third of the swing point high that was broken should get tested. And we have probabilities that are associated with that. The highest probability is that this lower third of that bar will get tested. And in fact, it did again and again and again and again and again until it resolved back to the top side. This resolving to the top side we call regenerate. In other words, if we break over it, we test, we can't break down, then we should expect it to regenerate to the top side. And that's the market voting with its pocketbook, telling you that the demand is greater than the supply. If it can't break down, then you should expect it to break up. That is the testing process. That is price discovery. That's how it works. And so as long as you can denote things of significance, like a swing point high, and you get a break of it, then you can look at the retest regenerate as a clue as to what the market wants to do. That's what you don't have in classical TA. You just have patterns. You have oscillators. You have derivative indicators. Here, we're looking at the testing process itself. We're testing, we're examining the tape, the process of testing that takes place on that tape, and using that to decide what our probabilities are for continuance or for a failure in a reversal. So there's only 2 types of trades. There's either breakouts, that's this, that's the breakout, or once you've broken out, it's the retest. Everything else is a derivative of those 2 types. The other piece of it is trend, of course, and we've already talked about it. So as we think about trend, typically you want to trade in the direction of the trend. So in other words, in this case, for example, we have a very strong trend that's taking place, and that can be seen here with the vertical angle of ascent that we see. You typically do not want to counter trend trade. Trend, think of it as the wind at your back. When you're moving higher, in this case, any place you buy, you've got the market supporting you. You've got it at your back. If you counter trend trade, you're going against the wind. And you better be very good at your timing. And in this particular case, there was a little reversal that took place to give you an indication that you should see a pullback. We'll talk about that later. But in general, that's a tough trade. Because if you don't have good timing and you don't get out in time, what happens? The trend that was in place before the counter trend just reasserts itself and goes again. And if you don't get out of that trade, if you're trying to short this market, for example, or this particular stock, you're going to get caught with the trend reasserting itself, and you end up losing money. The general ideal here, of course, is why try to catch this when it's so much better to just try to catch that, which is in the direction of the trend. A much easier trade, and ideally what you should be doing. So counter trend trades are very difficult. You got to keep them short and crisp, and you got to have pretty good timing to do so. Moving on to some of the other concepts and removing all the distractions from the chart, what is it that's important that we do? And that is that we look at all of our time frames equally. For the first thing we do is we always have 60 bars. So whether we're looking here, on this particular case, we're looking at a daily chart, right? The daily chart, 60 bars. If we look at a weekly chart, same thing, 60 bars. Nothing changes. If we look at a monthly chart, same thing, 60 bars. Always 60 bars. Why is that? Why do you want to have 60 bars? Well, the first reason is because 60 bars ends up being about the right of information. It's not too cluttered. The other thing is that you can apply the concepts. Those concepts I've just been talking about, you can apply them to all of the charts equally. They're all the same. You don't have to, there's no difference. If we think about it in a very logical fashion, if you have something here on this chart, the daily chart, and it ends up falling off the left-hand side of your chart, well, it's not really gone because it's going to show up over on your weekly chart. So whatever was happening here on the daily chart, once it falls off the chart, well, then it's on your weekly chart. And so you really won't lose it. It's still there, and you can still apply the same principles. And in this particular case, without having anything on the chart, we can see a huge volume over here on this particular chart back on the weekly time frame. And we're not going to be trying to pull back a very cluttered daily chart to find this. We got a nice, clean, crisp 60-bar weekly chart that we can locate that event on and use that information. And if it falls off of this one, well, don't worry. We still have it over here on the monthly chart. There's that high volume that you just saw on the weekly. You can see the significant event there. As price pushes up to it, it's significant. And when we apply the neoclassical concepts to the chart, you can see how significant it is or isn't. There is no resistance zone. And there's no resistance zone not because it's not significant per se, but it's because you can't draw a resistance zone because the price spread, the width of the bar, if we were to draw it, the resistance zone is going to be so wide it's not useful. Right? We're going to have a big wide zone that's not useful. Or if we use this one up here, it's going to be so wide it's just not useful. A useful zone is one that's crisp and clear and at a significant area, and it's thin enough to where you can identify its value. If I've got a price spread in this case that spans, $3-4, we're talking about 6-7%. It doesn't add that much value. So we can see with a naked eye, because we know the principles, the neoclassical principles, that this is going to probably create some sort of resistance. How much resistance? We won't know until we get there, and we'll have to see how it tests, right? The test process is always what tells us what is and isn't significant. Another concept, leaving this one and going to another concept, is that one of the things that you want to do is you want to see those areas that's significant on all your time frames, or at least a couple of them. For example, if we're looking at support and we're thinking about where can we buy this, well, the price zone on the monthly time frame is way down around 65. That's the last area that we can identify that was really worth buying. If we flip over, go to the weekly time frame, there we're going to see it's about 70, 67. So somewhere between 67 and 70. That's not a bad spot. You've got 3 overlapping, and right towards the top of that, around 70, is a good spot. And if we pull it down to the daily now, remember on the daily, let me grab the daily here. On the daily, it was around just above 70. So that tells us this 70 to 71 area really is a very good spot for purchases. Will it come back there? Well, maybe it won't. Maybe it won't anytime soon. But if that's the case, then you simply want to go find another place, to play your trade. The market, most of your homework goes without being able to apply it. And that's true of almost anything you do in life. And it's certainly true of the markets. In other words, you can do a lot of work. That's one of the reasons you want the tools to do most of the work, and we're going to get to some of those tools in the next session. But we'll get those things that identify good trade setups. We're just simply using this particular chart as a mechanism to discover the principles of neoclassical instead of a particular trade. So coming back to the document, 3 time frames. If you're like, and it doesn't matter if you're a day trader, you got 3 time frames there too. As a matter of fact, you could use a 1 day, 30, and a 15, or you could actually have 4 time frames if you chose. In swing trading, you're probably going to be looking at daily, weeklies, and monthly. Longer term trends and time frames, right? They tend to have greater significance. The shortest term time frame is really for the entry and exit timing. You're looking at, if I were swing trading, I would be looking primarily at the weekly chart, not the daily. I'd use the daily as the timing, or even pop down to a 30-minute chart maybe for an entry. 6 bars in Neoclassical is the key to almost everything. It's what you use to do the swing point actualization, but it's also the same thing for retest and regenerate. And we haven't talked about that much. But I do want to focus on it one more time. So let's look at that. And again, using the same chart, I've just cleaned it up now to where we're only seeing swing points and swing point breaks. Anytime you get a break of a swing point, like in this case, we got a break here to the downside. Unfortunately, we can't see what that low was that was broken over here somewhere, so we can't use that one. But we can certainly take a swing point high that was broken and use it, and we actually have one. Well, actually there's a couple of them, so let's use these. There's a swing point high here that was broken with this break, and then there was another one here that was broken on this breakout, right? And actually we have one more, but that one hasn't been retested. So let's take the first one. A retest regen, of course, is when you break over something and you want to retest it. If you come back within 6 bars like we said, right, it should trade into the bottom third. And again, it does that. Trades within the bottom third of it. As long as it doesn't break down for a couple of bars underneath that zone, then that's potentially a regeneration to the top side. And that is what happened on this one. If we look at the next one, swing point high here, it gets broken here. There's the retest. Now here is a single bar that gets under and closes under it. It's the close that we're interested in. But the very next bar gets back over and into the zone, and you stay in the zone all the way up and then eventually regenerate higher. And so it gets into, I call this a full retest regenerate. In other words, it comes all the way back and goes all the way to the bottom, not just to the bottom third, right, but all the way to the bottom of the bar. So it fully tests it, and it holds, and it regenerates. And again, we like to see a couple bars disqualify a retest regen. If we look at the last one here, now this one is more interesting because this one, and this actually fits in with the other thing that we were just talking about, and that is that the 70-71 area is going to be extremely high probability buy. Well, not only is it high probability from the standpoint of the support zones that we just looked at on the dailies and the weeklies, but it's also high probability because it's going to be more than 6 bars before it comes back. And the probabilities go up tremendously when it's more than 6 bars. Matter of fact, they get extremely high. And so anything that comes back to retest this area is almost an automatic close your eyes and buy it. Again, probabilities. We know what the probabilities are, and therefore we can make good decisions about where we want to concentrate our monies. If that test were to take place, almost guaranteed you would make money by buying it. No guarantees for sure, right? But a very high probability. Now, if we're speaking about the probabilities, those are included in the Trend Trade Setup books. But in this document, I've also included some of the key stats, graphs here in the document. And one of them, I'll just take one of them as an example. You can look at some of the rest, and we may refer to some of the rest as we go through the document here. But the first one that's up here is the retest regenerate. And it's so important because, most people, or a lot of people, want to buy the breakout, right? Buy it as soon as it breaks out. And in some cases, that works. And matter of fact, if you look at the statistics about how often it works, in a confirmed bullish case, you certainly have the better opportunity, or in a confirmed bearish case. In other words, volume expands on the breakout compared to the other case where volume is less on the breakout. When it's less on the breakout, there's less enthusiasm. That's true of the upside and the downside. So the probability that you're going to come back to the breakout area is higher in that you're going to come back faster, sooner. On the confirmed one, it's going to take longer to get back. 68% of the time on the confirmed breakout, it comes back within 6 bars. Or actually, in this case, it's 5 bars the way I had it set up. If you do it here, it's about 82%. And similar numbers on the bearish side, almost the same on the suspect and or on the confirmed, and a little bit less on the suspect. So the idea is that you are going to see a retrace in most cases. Not all, but in most. And the one case that you really want to focus on, if you're going to buy the breakout, is the confirmed case, right? Confirmed bearish or bullish. That's where your highest probability is that it won't come back, but still 2/3 of the time it will. Now, then you can get into another idea, which is like, how many bars, once you get a breakout and you get above a certain price, even if it just keeps going, how long will it go before it comes back? Well, I looked at it in more than 60 bars, almost nothing. If you look at the long-term time frame on more than 60 bars, it almost always comes back. But if you go down to even, say, on the intermediate term time frame, there, 82% of the time, 86% of the time, depending on the type of breakout, still we're in the high 80s. And it's also in the high 80s, very high 80s on the short-term time frame of the suspect. On the bearish. And so what this graph tells you is that when you get a breakout to the top side and it doesn't come back immediately, that thing can go for a long time. But eventually, the odds are it will come back. On the bearish side, those odds are very high, whereas on the bullish side, not as high. So if you're going to stay long for a long time, you're going to want to, if you're going to stay with a breakout for a long time, you want to do it on a long, on a purchase, not on a sell. Because on the sell, the probabilities are fairly high that you will be back within 60 bars. And that makes sense if you think about it. When you break down to the downside, that doesn't keep going that long. Eventually it comes back, and it certainly comes back more often than it does if you break out the other way and keep going in the bullish case. And we could go through each of these graphs. We'll probably come up to some of them. This one has to do with, on a retest, regenerate. You can test on a breakout. So you get a breakout, you get a retest here. What happens if you regenerate? Well, you can always get another retest. This talks about the probabilities of failure, and you can see that the more times you retest, the higher the probability you're going to fail. And that makes sense, right? The more times you hit something, think of it as a supply line. I break out, there was supply at this breakout level, right? For whatever reason, as I hit this thing, eventually I get through it. Well, once I get through it, when I come back, now there's going to be a demand on that same area. And if I hit it enough, eventually I can break it back down, and that's what this chart is about, and it assigns all the probabilities associated with it. And we can go through all of these, but you'll see what I'm talking about, that the statistics are there. You just need to use those statistics to make wise decisions, and it's fairly simple concepts. Because we've broken it down to retest and regenerates and breakouts, only 2 types of trades. The odds of those are outlined for you. You can see what all those odds are, and you can use those odds to make wise decisions as the trade unfolds. And you can actually even use those odds to make wise decisions about, should I buy a breakout, for example? Let's say the market is breaking out. Should I buy this breakout? Well, if it's a confirmed breakout, I have a better probability of it going higher, right, comparatively. If I'm having breakouts all over the place, across all the sectors, I even have a higher probability. And so those kinds of things come into play, and those are the kinds of things that you want to be looking at to make wise decisions and put the probabilities in your favor. What you're always trying to do, right, in all cases, is you're trying to say, if you think about it, about like going to a casino, I don't want to play the same amount of money on every hand, right? That's a no-no. I want to put the most amount of money on that particular hand where I have the best probability of winning. I want to put most of my money on that hand. I want to put a little bit of money on the hand that I don't have a high probability on. That's true of trading. When you get a high probability case, you want to put a lot of money on it. When you don't want to put too much, right? You want to save that money for something better. Find a better trade, find a better probability, and use that to spend your money on. So we've talked about anchor bars. We've talked about those being of three types. We've talked about the anchor zones. One thing that we didn't talk about so much was the congruent anchor zones versus the overlapping. So let's take a quick look one more time here at our charts and point out one of those and to how those work. And so I'll bring up the DuPont again. I'll apply the anchor bars and zones so you can see them. And now we can actually talk about how they're constructed. Now, the algorithm takes into account a number of things. One thing it definitely takes into account is all of your anchor bars. So the algorithm is an exhaustive examination across the 60 bars, finds all the anchor bars and ranks them. And so if I'm looking at this anchor bar here, right, high volume, wide price spread, swing point, that gets a 3, right? Gets all 3 of the possibilities. This one's wide price spread, high volume, but it's not an anchor bar, so that one would get a 2. And so it ranks them all. Once it has them all ranked, then it goes through and says, okay, based on where that high-ranking bars are in terms of price, if it was way over here, it would get less value than if it's over here, or it would get even more value if it was right there. So it uses that knowledge as well. And it takes, once it's ranked them, it looks for all opportunities to combine them. And by opportunities, what I mean is the zone, and we'll talk about how the zones are constructed, but if the zone is too thin or the zone is too thick, it disqualifies those. It won't use those. And that's an algorithmic measure that it uses. As far as how does it put them together, let's look at one of these in particular. You see this greener, this heavier green? That is using, in the blue bars or anchor bars that were used to construct anchor zones. There's other anchor bars on here, but the ones that are blue are the ones that got used. Bottom of this bar, and see this blue bar here? You can see it's right at the top of that bar. Now those bars do not overlap, right? They're not overlapping. They're congruent. They're close enough together, but not too far. And they're congruent. They're very, they don't overlap, but they come close. That's one form. The other form is overlapping. And for example, here, and I'm trying to see which one's overlapping. Looks like this. Let me clean that up. This price point here down to that price point there. You can see the overlap between this bar and that bar. They're overlapping each other. So anchor zones consist of overlapping and congruent anchor bars where the price spread is not too thick or too thin, and where the value of the zone itself is created from how close they are to the current price, how highly valued the bars are that created the zone, right? Those things all come together, And then the other piece is how close is it to the current price in terms of distance. Once you have those three things, it takes those, uses those to construct wherever the anchor zones are going to be. That's how anchor zones are created, and that's their value to you, because they're finding the closest place both above and below price to show you where supply and where demand should be found. That's that price projections. Now, I haven't talked much about price projections, but let's do that on the chart. And we'll look at, let's use the daily chart again, and let's take a price projection off of something that we had. The most common price projection that we use in Neoclassical is a price projection mechanism that's used in classical, which is called the ABCD structures. And what it essentially says is that I take some low, right? And as long as I get a higher high than the prior bar, and I get a higher low than the prior bar, and this is for going up, then I keep moving up. And so I would take this low, and I'm looking for a B point. The first place that I see a lower high, a lower low, the highest bar, the highest high from that A point, this is our A point down here, the highest high from the A point until we get that lower high, lower low, that becomes our B point. And so once we get that, we go searching backwards, we find our B point. Now what we do is we keep going lower high, lower low, lower high, lower low, and until we get a higher high, higher low. And when we get that, it switches around. So in other words, now we go find our lowest low, which is here, and that becomes our C point. So once we get the C point, we can mark it and say, okay, that's a C point. Now we're looking for the D. Now the common thing to do is to take a one-to-one projection, and that is to say, what is the distance between this point and that point, the A and the B? In this case, it's about $3. And in Neoclassical, we do it a little bit differently. We take the percentage, and in this case, it's almost the same as the arithmetic, and we project it forward. And we say, okay, from this price point, add the same percentage gain to it, and that's our projection. And so we use that to project where price is going to try and get to. Now what we found is about 95% of the time, these projections are met, somewhere around 95% of the time. And so what you want to do is ride this thing up to about 95%, which in this case was probably about right there, which is that high. And so that's the ABCD projections. As far as this one, it's a little bit different because it actually had a lower low here than there, so that would have deconstructed it. So we would have, even though we may or may not have gotten stopped out on this, we had this very convoluted up and down stuff that was taking place. Now a much cleaner one that actually worked very well was here. Here's your low, there's your B point, here's your C point. Now you take and project that higher, based on the distance here, percentage-wise, and then that's an ABCD structure, and this one was very clean. It just headed straight up there and went and got it. Those are ABCD projections. Now the other thing you can do is range trades, range projections. And usually those work better on longer-term charts than they do on the daily charts. And I'm going to look to see, and they're more of a visual thing. And so I don't usually use them that much because they're more apt to have error. This might be a little range in here, where price traded sideways for a considerable period of time. Sort of a range in here, although that was a little bit more of a stretch. But that one's a pretty clean range. And once you get a range, the way you project with it is you simply double the range. And so I would take this, double it, right, and just apply it, put it on top. And that would be my projection. And so the projection here is to take it up to about 77. And if you remember or actually it's about 76, if you remember from the long-term chart, on the monthly chart here, we actually had 76 or so as being the top of this bar, if I remember right. Yeah, about 76. And so you could see that projection projects right up into that swing point high. And so when you see things, again, as we emphasized earlier, when you see things that apply to this chart, knowing that probably should be some sort of resistance there, and if we move back down to our weekly and we see we have a range projection that takes us up to about 76, now we have two things telling us that this may in fact have some validity to it and we should pay attention to it. And so that's how you use range projections. Reversals come in two flavors in Neoclassical. And again, these are not things that were created as part of the model. They were borrowed from the classical. But they're simple tools that you can use. The two tools are both intertwined. One is a two-bar reversal, which is the better of the two. The other is just an over-under. And since I happen to be on the weekly chart, we'll just use it and look for one. And so what we're looking for, an over-under or a two-bar, is where we get an extension in price. And like here's a good example where we extend up and we reach some sort of a pinnacle and the angle of ascent is very steep. When you do that, right, what you will find many times is that you'll see price get over the prior bar, in this case they're weekly bars, and close back under it. And volume will be lighter. If the angle of ascent is significant and the distance from this price to that one is significant as well, and in this case we went from about 51 to about 65, so that's a roughly $14 on a $50 base, which amounts to roughly 28%. So 28% is a fairly significant move in a month, a little over a month, 6 weeks. That is a two-bar reversal. And a two-bar reversal says that what you should expect is that the very next bar at worst should be sideways and more than likely will be down. And these are fairly high probability trades. And whether you're just taking profits on them or you're actually trying to short, usually you want to actually just be taking some profits more than shorting. In other words, you just had a huge move. That move is probably not going to just die. And so that may be a place that you want to try to take some profits and look to trade back into it on some sort of a retrace. That's the whole idea of a two-bar reversal. Now, what you should expect, the ideal entry on a two-bar reversal, is the top of the wick of the prior bar. In this case, it was 65.17, and on the next bar, price got up to 64.78. You got pretty close. So as you get close to that bar, that's where you want to initiate your sell if you're selling, or if you're doing a short-term, counter trend trade, that would be where you initiated your short, and your stop would be over the top of the next bar. Now, naturally, some of these are going to be better than others. For example, if this bar, let's say that this bar's top really wasn't here. Let's say the bar's top was, up here somewhere. Okay, so if it's that high, do I really want to initiate a short if I can't put my stop until here? No, because your risk and reward doesn't make sense. There's two things that determine whether you make money or you lose. One is the reward to the risk, the ratio. And usually, you got to get at least 2 to 1. You'd like to get, 3 or 4 to 1. And if you get more than that, you're probably dreaming because it's probably not real. Sometimes they'll turn out to be more than that, but usually they're not. The other thing you need is the probability of success. Now, everybody talks about reward and risk, but nobody talks about the probability of success. Now, why is that? Well, because nobody knows what the probability of success is. But in Neoclassical, we do. We do have probability measures, and we can use those to make good decisions about the probability. So now, in Neoclassical, you actually have 2 decision points that you can use to make a decision not just the one everybody else is using. We use reward and risk, and we use probability, right? The probability of success. POS. Big difference. Now that was a 2-bar reversal. A over-under is exactly the same thing, but the over-under is where you don't have that same sort of extension. Not as high probability, not nearly as high probability. And so if we look at this one, we can actually carry this example forward. Now look at the angle here. Fairly good angle still, but you've gone sideways for a while. So this no longer is a 2-bar reversal, even though it gets over and back under. So the high here and the close here is lower. And it also isn't a good 2-bar because you don't have the right volume set up. Volume was heavier on this bar versus the bar prior to it. So let's find another one. If we go a little bit farther, here's one. Here we can see an over-under. Again, if we go from the ascent angle, right, now it's less and less steep, right? We're no longer in the steep angle. Now we can see that this one actually has a 2-bar reversal that makes sense. You go over, you go under, and you do it on lighter volume, these 2 bars. So that's a over-under, and that says that you should get the next bar down to sideways. And that's what it did. Now the probabilities here, not nearly as good. What you really are looking for in a trend where the trend is up in this case, right? You got a nice strong trend to the upside, is you're looking for some sort of a reversal the other way. In other words, you're looking for a retrace that gives you a reversal. For example, a really good one is right here. Look at the volumes. Trend still up, right? You're testing a swing point low. Here's the test of the swing point low. This is the low. And you're actually testing this one as well. You test both of them. You can't close underneath them. Neither one closes underneath it. And you end up with a reversal in both cases, and in this case hammer reversals, lighter volume. This is an ideal case to get long, and you see what happens after that, right? You get a nice push again, and eventually you get even more. That is 2-bar reversals and over-unders, and how to try and use them properly. Although you can use them for counter trend trading, ideally you try to use them more so for continuation trading, where you get the pullback inside of a move that's higher. Magnets. Now magnets we haven't talked about that much, or actually we haven't talked about it at all, but we've actually touched on it without calling it that, and we were doing that here on the weekly chart, on the monthly chart. A magnet is where you get a high volume spike, in this case a high volume spike, right, that just stands out like a sore thumb. That is a magnet once you get into it. So if you take this trade and you look at it, there's your magnet bar, you trade down, and it doesn't mean anything until you get back into it or get close to it. And once you do that, you're magnetized towards the highs, right, if you're going up. If you had a magnet on the downside, it would be the opposite. You would be magnetized towards the down, right, the bottom of it. That's a magnet bar. A lot of times those can be valuable because they give you a measure, a projection of where things are trying to go to. A couple other things real quick, scale in, scale out. Most good traders do not trade everything at once. They don't buy everything at once. They don't sell everything at once. They usually scale in, scale out, 2 or 3 purchases. And they do it in such a way that they add value. In other words, let's say that you're making purchases, and let's go back to our DuPont chart. Since we're wearing this chart out, let's use it one more time. Let's say that we wanted to buy into DuPont. We noticed that over here, and let's mark this up as we go, we notice over here that we break this swing point high, right? And that break, let's just draw it the other way so it's cleaner. Once once that breaks, and where is our break? It's right here. Once that breaks, right, now we know that we've got a trend transition, and eventually we get a bullish trend transition. Down here, we actually test, and we fell to break down. And even though volume was higher, right, on that big spike down, we did not, right, we did not stay down there. We immediately reversed and went higher. As this comes back, right, potentially good places to enter. Maybe we would buy some here thinking it wasn't going to get any lower, and it actually gets all the way down here. And so what we do is we put a trading plan together that says, you know what, if this were to trade this low, I have to stop out. But given the width of this bar, I know a third of it is about here, another third of it is about there, you know, something like that. I want to buy a third down, another third down, and then right towards the bottom if it still looks good. 3 purchases. And I want to do them in measures that give the advantage to me, and I can wait to see how things test to decide, do I want to buy or not. For example, this high volume when I might not want to buy this second purchase, but over here I may in fact want to buy it because I see volume shrinking, right? That's probably a good place to make that purchase. Maybe I buy 25% on the first purchase. And then when I purchase again, I buy maybe 35%, right? And then my last buy, if I'm going to buy it, is 40%. Why is this? Well, because I want to get my average cost lower, right? I don't want it higher. I don't want to buy as much each time. I want to buy more and more so that my average cost on the 3 buys is not here in the center of where the buys were if they're all equidistant, but somewhere down in here. That's the idea. And so scaling in, scaling out is just a money management technique to get you in a better probability case to win. The other thing you have to do is have confidence. You know, a lot of people find it very hard to buy into retraces. And that's understandable. I mean, when you're looking at these charts and you're looking at, say, these retraces that are coming back here, you know, these can be very difficult to buy. But you know your odds are the best if you have the probabilities in your favor. Your odds are the best because you're getting a lower and lower to wherever your stop's going to be. And so you got to have confidence that this stuff is going to work. And given that we know what the probabilities of it working are, it's just like the casino. The house wins. If you put the odds in your favor enough, you're going to end up winning. And so through practice and mental acceptance, you gain that confidence to make those kinds of trades. Okay. At this point, we've talked about, you know, most of the principles. There may be a few more, but we've highlighted most of the principles. There's not that many in the model. You know, the best model that you can create, you know, if it captures most of reality. So if that's reality, and if our model can capture the majority of that, that's a good model. The second thing that you want a model to do is you want a model to have just as little rules as possible, right? Maybe you just have, you know, I don't know, 10 rules. Maybe let's just call it 6 or 7 rules. I mean, that would be the best model, 7 rules. And within those rules, right, you don't want very many interactions. You want just a few interactions. The fewer, the better. So in other words, you capture most of what the reality is that you're trying to model. You don't have a lot of rules, and you have very few interactions. That is what the neoclassical model does. It captures most of the market. It doesn't have very many rules. It's got about 7 or 8, and it doesn't have a lot of interactions. There's a few, but not too many. That's a good model. So that's the neoclassical principles that we've talked about, and so we've outlined those. And then if we go back up here, if you think about the trade setups, you know, we had talked about the setups, the odds that are associated with them. They're all outlined here in the document. We'll talk about some of those as we start getting into the trades, but those we've started to outline. The other thing that we haven't talked about is you need to understand what's moving the market. I did talk a little bit about the primary determinants. You want to be aware of what those things are. But you really want to understand the relationship between the markets. And this is something that comes with experience. I want to know that, most of the time, gold and silver trade at a ratio of, 4 to 1 or 3 to 1 or whatever the number is. I want to know that, relationships, they ebb and flow. They're not cast in stone. So things will change over time. I want to know, there's things that you need to just know. And those things are things that you gather with time. Central bankers are important. You have to watch those. That some economic reports are more critical than others, and that some of those reports are more critical at certain times than others. Those are the kinds of things that you have to just learn over time. They have nothing to do with the model. They're just trading things. You have to find the higher probability trades. We're going to talk about that in the next session. And you have to have a set routine each and every day. You need to come into the market with a set routine, what you do. And it may be something like I do. I usually scan the resources the first thing in the morning. I don't do it every morning, but I do it most, or I do it in the evenings before I go to bed. I consider what's driving the market. I review any news items, known things that are going to happen, right? There's two things that can affect our market. There's things that we know that are out there. We know a Federal Reserve meeting is on day X. But then there's exogenous things, right, that can come along that you don't even expect that can do something to the market. These you can prepare for, and many times these get discounted before they happen. The market has a way of discounting them. These, they come out of the blue, and you have to just be prepared at all times to deal with whatever they may be and assess them. And usually the market will give you clues as to how they're being assessed as they take place, as long as you're reading the tape and as long as you're able to understand what's significant and what isn't. So you have to review those things. Multi-day thesis, you're going to have a thesis of what's going to happen. If you're day trading, you're going to want to examine things intraday. And during the day, it's good to kind of keep tabs on what's happening. I usually take benchmarks, look at volumes so that I know if it's a high volume, a low volume day. Because it's just important to understand what kind of volume is either coming into the market or isn't. You want to keep track of the major sectors. One thing we haven't talked about yet is that and we'll get into it. Matter of fact, let's do it now. Actually, we'll take that up when we do the tools, because we'll look at the trading cube, which is one of the tools where this comes into effect. And you simply want to monitor and synthesize everything that's happening over time. After the trading day, you usually want to review what's happened, take a quick look, and you want to prepare for what's coming next. And so if you develop that sort of a rhythm every day, you'll find yourself much more prepared for whatever comes your way, and able to fire off the trades that you need to fire off without hesitating or without being like a deer in the night and stuck in the headlights. Okay, so that's about it for the first session. I'll come back. We'll do another second session where we look more at the tools and trading in particular using all of these concepts.